Welcome to another riveting edition of Risk and Return. I'm Charlie Gasparino from Fox News, Fox Business, the New York Post, donning my S3 fleece because my partner in crime, the granddaddy of data, Bob Sloan, is the inventor, creator of S3 data, the number one data provider on the Bloomberg network, the best positioning tool you can have if you're in the markets right now, trading short-term, even long-term. And that's why we call him the granddaddy of data. We are going to get into some of Bob's data points in a bit, but we would be remiss not to point out at the top of the show, Bob, that the market was down 1,000 points plus. The Fed held interest rates steady, which I guess intuitively I thought was bullish because he's not raising rates. And it's sold off anyway.
No
Unpack this a little bit for our viewers, because you know this stuff better than anybody.
I mean, he repeated the 2% guidance, which is very strict, right? And he didn't give any forward guidance, so people took that as bearish. And we've seen that in a number of the bond ETFs. So that there's no one really short in those bonds, right? In other words, I think yields are going higher. So we've seen that in equity markets and hedging vehicles for a while, that people have been anticipating this type of Fed messaging for quite some time.
I had an interesting conversation with a very prominent financial services CEO whose name we won't use because we spoke on background, and I want him to keep speaking to me. And I said, "What do you think Warsh will do?" And he basically says he's going to hold it steady, but he shouldn't. Here's what he said. The Fed funds rate doesn't matter that much for people like him or people that want to finance deals. And, if you're a C-suiter that looking to expand into capital improvements, you care about the longer end of the yield curve because that's where you borrow. You borrow on the 10 and the 30 year. And this is what he said. If he wants long rates to go down, he should raise rates, the Fed funds rate.
Yeah.
The yield curve is more important than the Fed funds rate. We are seeing a shortage of capital for the AI build out. The demand for capital is insane, lifting long rates higher. I guess what he's really saying is that, listen, if you want to sort of raise short-term rates, you really throw a bone to inflation hawks, then maybe the long end goes down a little bit. So people that are borrowing on the long end, could keep borrowing. There's more liquidity for this build out, which, let's face it, the AI build out is what's powering the economy in many ways right now. What do you think of that statement?
Well, look at Microsoft after the bell. Microsoft's up like 4%. They're still spending money. And one of the things that people are looking for in the next earnings call is that there's some kind of forward guidance on CapEx, but they're still spending money. They had strong earnings. So I think he's right. The CapEx spend, just to put it in perspective, let's just call it $1 trillion. That's bigger than the money raised for all venture capital investment. All.
We should point out that's amazing. We should point out that rates haven't really changed much on this news, and I don't think they would, because I think the market was sort of pricing in him doing nothing. But there's been a fairly dramatic, rise. I mean, the yield curve is wickedly steep right now. I mean, it's nuts how steep it is.
Yeah,
and if that's crowding out or making AI borrowing costs expensive, there is that could end this bonanza that we see. Don't you agree?
Yeah, right now, no one's really done the sensitivity analysis that says, okay, if rates are 50 basis points higher on the 10-year from where they are today, or they cross 5%, what does that mean? What does that mean for demand? I mean, what does that mean?
By the way, rates went up today.
I'm not sure it really matters that much if 50 bits. No, 200 bits, 150.
Well, the 10-year is trading right now at a yield of 4.69. Okay, well, there's 4.7. That's higher. The 30-year is at 5.22. That's higher. So it's steepened on this, and so I guess that my source there is right. I mean, I don't understand Trump's fixation with the short Fed funds rate. I was at a conference once where I heard Besson talk. He goes, "Oh, I finally got," and I'm paraphrasing a little bit, but not totally. And Scott Besson is the Treasury Secretary, should point out. I finally got the president to stop worrying so much about the Fed funds rate and focus on the 10 and the 30.
Right.
And Trump came out the next day and said, "Oh, should be lowering rates." And, that's when he was on his jihad against Jerome Powell. And as you know, the Fed really just controls the Fed funds rate, unless you do wicked market intervention with QE, where you essentially go in and buy or sell treasuries, which is not a great practice, monetizing the debt. But I guess my point is that, is this something to be worried about if these rates keep going up?
Well, like I said, if it goes up, I don't think 25 bits or 50 bits is going to matter. I think something north of 5.25, 5.5, you start changing things by like almost 100 basis points.
On the 10-year or the 30?
10.
Okay, gotcha. But we're far from that now.
No, but you go to 5.5 from where we are today. Yeah, you'll see a slowdown in CapEx. Right? It's just that much more expensive to build, but it needs to be built. So, I'd love to see, and we don't do this type of analysis, but if I were in a fund right now, I'd say, okay, what's the likely dampening of demand to build data centers, given a 25-point hike, 50, 75, and 100 over time? And if you think short-term rates are going from, let's say, 4 to 6, what does that do? That's a pretty dramatic move.
Yep.
So
there are now the Fed funds rates between the targets between 3.50, 3.50, 3.75, right? Something like that.
Right. So yeah, you start raising rates to 5%, and the 10-year staying at the same spread to short-term rates. Well, yeah, that would matter. But 25 or 50 basis points, I'm not sure that's going to stop anything.
All right. Well, the market's a little spooked about something today, but
well, we're obviously, I think price of oil right now is overshadowing the Fed. I think the surprise attack by Iran and the oil volatility is what's really spooked the market pace. Plus, we'll go into a little detail later. We're foreshadowing a little bit. I don't want to take away from your headlines, but we've been all over the Kospi and the single stock ETF in South Korea, and that is now below as a spread below Hong Kong. So,
oh, really?
That spread is foreshadow a lot of this move that happened first, and then it reverberated over here. So, particularly with the failure of with Hynex, right, being such a disaster type. So, we'll get to that. But Charlie, you got your stuff.
Yeah, let's go through it quickly because I do want to get to that. That's important stuff. I'm looking at the overall markets. I'm looking at Warsh. I mean, a lot of people, like I said, a lot of C-suiters were saying raise rates. Now, remember, it's a balancing act. He's got a president who appointed him who, let's face it, does not like that. Still doesn't buy the notion that the 10 hates it. So you can't do it now. I think he needs a little breathing room. And then if this persistent inflation, I mean, if the war kind of ends or in a positive way, if oil prices come down dramatically, he can maybe not have to do it, or he's got more running room to wait. So, I like Kevin Warsh. He's a smart guy. I mean, he's in a very, very difficult position.
Hugely tough.
I mean, it's just because you have the markets on one side and you have this president on the other side that wants lower rates and still hasn't been convinced that it's the 10 and the 30 that you have to worry about. So, and so out of the box, I think he needs a little bit of respect, give him a little break, and let's see what happens in the coming days. So I'm following that. I'm also following Mr. Mondami's little list of people that own pied-à-terres or second homes that are worth more than $5 million. Although the numbers are all over the place. Some of these houses that make this pied-à-terre tax or homes or dwellings, I guess is the best way to put them, and make this tax, and it's a higher tax, second home if you live outside the city, are not quite $1 million homes. They're these $5 million homes. They're like in the $1 million range, just based on what type of dwelling they are. It's a little complicated, but mostly it falls on the $5 million and up. And he recently published everybody's name I'm surprised you're not in there, Bob. Yeah, but you live in the city, so you can't be. But I mean, listen, Donnie Deutsch was in there, right? My buddy Donnie Deutsch.
Well, a lot of people were in there. The tax rolls are public record. If you really determine
Yeah.
name and address, you
Don't
can't.
make it. Don't make it easy for wannabe.
Yeah. So you've had a personal experience with that.
Well, yeah. I mean, I think I told you about this. I was during the financial crisis, and just so you know, I reported about people who were about to lose their jobs because Wall Street. Let's face it, without the bailouts, 90% of Wall Street was insolvent of the big banks. They had assets that were worth less than their liabilities, and that's insolvency. Maybe JP Morgan wasn't, because Jamie Dimon had the foresight not to totally jump into the subprime mortgage lunacy, right? Not totally. I mean, he was in there, and they paid some. They had to pay some stuff. But so every other bank is done, and I was reminded of this last night. I was watching the final days of Lehman. It's some sort of a docudrama, and kind of a stupid portrayal of Dick Fold. Idiot, it's some like idiotic thug, which he wasn't. I knew Dick Fold very well. He was actually a pretty smart guy. I mean, just made mistakes like everybody else. But so I'm covering this. Obviously, a lot of Wall Street people don't like it, and they don't like my reporting. I've never had death threats before until that time. And this imbecile from the Greenwich Times or something, publishes a story where it says where I live. Now, I know the person's excuse was, you can find that in the phone book or wherever online. But I made the case to them that why make it easy for someone to say, oh, here it is. Have a few drinks.
Yeah.
You're reading the thing, and let's go to his house and throw a brick through his window. And I remember arguing that, and they took down the story. And it's similar here. I mean, if you do a little digging, you'll probably find out where these people live, right? Just putting it out there for everybody to look at, particularly this guy, particularly his audience. The mayor's audience are radicals. I mean, let's face it. I mean, he is part of the DSA. They talk about confiscating wealth from white people, homeowners. I mean, they're just, if you want to listen to the DSA platform, go online. And one of my colleagues interviewed the head of
Craig, I saw that.
one of my colleagues on Fox News Sunday, Shannon Breen, did an interview, and she just asked really good, simple questions. And this person just said, yeah, we want to take away property. Yeah. Open borders. Yeah. Everybody on welfare. Just on.
Wait. Yeah. Let's blow up the presidency.
Yeah. Let's get rid of the Senate.
Let's get rid of the Supreme Court. Let's get rid of so what takes its place?
Well, they're communists, and they want they want Marxism. So my point is, by publishing people's names, you've essentially created, and the Post has coined this term, not me, an enemies list of people that are. It reminds me of that scene in Batman, right? One of the Batman with Bane. Remember the whole thing with Bane and the mock court that he had, where you had to go in there and prove why you shouldn't die, but because you're already guilty, and then they always executed the person.
Played by the great Tom Hardy, by the way.
Yeah, it was a great scene. It was one of the great movie, by the way. The Tom Hardy was amazing.
Amazing.
The judge in the movie, I don't know who that was, but he was just he reminds me of these DSA guys. I mean, all just the radicalism, but so you're giving people sort of a list and a sort of map to find their enemies.
Well, but aren't these people the very people that need to fund New York City?
Well, that's the whole thing. I mean, this has always been a financial story as I'm concerned. The business community is going to fight back. I'm reporting that in the Post today. They're going to take efforts to try to create lists, mobilize people to elect non-DSA candidates, which they should have been doing a long time ago. But they're doing it now. I talked to Steve Fulop, the head of the New York City partnership. That's exactly what he's doing. That's someone we should get on the air, and I think he will do our podcast. And the other financial story is who wants to own New York City municipal debt in this environment? Now, here's the thing. In reality, Bob, it should be a big, great time to buy New York City municipal debt, right? Because taxes are going up. It's triple tax free. It's a check. Many bonds is a tax shelter. But guess what? People are selling, and they're selling because it's only a tax shelter if you think the mayor is not looking to blow the place up. And he's making noises like he wants to blow the place up. So as I've been reporting, prices are going down. Yields are rising on these New York City munis. And it's pretty damn scary.
Well, one of the things I think these folks are going to get introduced to is jump risk, which is, for those listening, it means basically how far do yields have to rise before they settle in? And what happens in jump risk is that, let's say that yields go from 4%, triple tax free to 6. It doesn't mean at 6 they jump back in. It just means it can go to 6. So I don't think folks really understand what they're doing when they actually release a list like this, because the very people that
those are all the people that might buy
municipal debt are the very people that you're saying, are you got mail, and they're going to say, guess what? You got to come to market to me to buy your paper.
Right. So just so you know, if you live out of town, you don't get the break on the city side of the tax, but you get this, you get the other stuff. Like if you're a New York resident, you need, like, say you live in the Hamptons or Westchester and you have a credit here, you get the double tax. So I mean, it's very stupid. And if you live in Florida, you get single. It's still not a bad deal. It's still tax free, right? It's still right, and it's kind of, in the past it was low, like extremely low risk. So it's really dumb. We'll leave it that there. I want to put a cork in that for now because we're going to keep coming back to this because I am tracking this daily. 2 stories I want to get to and get to your stuff, Bob. Any thoughts on Anthony Fauci? I find him to be such a tragic figure. I mean, so I was never a Fauci hater, just so you know. I'm not someone who thinks the vaxes are poison. For all I know, the vaxes took the edge off the virus and forced it to mutate to a less aggressive strain.
Right.
And I don't think I'm totally off the wall by suggesting that. I was vaxxed twice and I got COVID 5 times, just so you know. But easily survived it, probably more than that. I mean, who knows? If I just stopped caring after a while. But the first time I got COVID was in late 2021, where the strain was still, kind of nasty. It was like a flu. I worked out through it. I lost my voice. I had a nasal drip, and I lifted weights every day with it.
My view of the Fauci testimony is,
and it's not just the testimony, which you point out, his diaries were real time crazy town. Like I always wondered with him, Bob, why would you stay in government this long when you can make a lot in private practice, unless you like the power? And he seemed like this egotistical guy that kind of liked the trappings of power, to tell mayors, calls up he says he didn't cause any of the shutdowns, which technically is true, but he did brag
admitted to the people
emails that he called like de Blasio, and he called Newsom and convinced them to lock down harshly. But I'm sure when he called up Ron DeSantis in Florida, he was told to, like, okay, pal, go fuck yourself.
Wow.
So what's your take on him? Is it just like a guy that just got caught up in his own celebrity too much? It's a scary thing for a public official of his power.
Well, it just shows you, I think, how intoxicating the medium that we're on right now really is. And I think it's a cautionary tale for anyone that wants to be famous. He obviously wanted to be famous. And how do you keep yourself in check and not get carried away with it all? When millions and millions, when the world is turning on your very word.
Right.
How do you manage your own emotions and how do you manage your own ego? And I saw someone today that was so, every time he took the fifth, his voice got softer and softer.
Yeah.
Softer. And you could tell it was hitting him that where he was. I can't believe I'm in this place where I have to actually not testify because I'm afraid of incriminating myself. Wow. Which means, for people listening, why would he do that? Because he's obviously given testimony under oath that's directly opposite of what he's actually in his diary, and he's perjured himself. And so he doesn't want to do that again. So that's the point.
My brother is a doctor. My brother is, by the way, he's a research PhD as well. He's always held Fauci in high regards. So I used to take my cues from him, but reading those diaries, I just lost a lot of faith in the man. And I think one of the things it proved is that he was just not being straight with the American people. And he was politicizing this. I mean, it was standard progressive dogma that people who spoke up against vaccines, who warned about, they do have side effects, by the way, sometimes very dangerous side effects. People who said harsh lockdowns are just not good. It causes more harm than good. And there's legitimate evidence there. There are countries that did not lock down harshly and had a better outcome than us. I'm not saying that the high risk people shouldn't lock down, but like for everybody to stop doing everything, has devastating impacts on society, unless we're talking about the bubonic plague here. What this was a flu plus.
Yes.
He said it. He said this is like kind of worse, like a flu, but worse, And, it seemed like he had a higher purpose. He wanted to do something good, and by fudging his knowledge, medical knowledge, to try to fit a political narrative, which was lockdowns, vaccinations, don't blame China, even though they deserve all the blame in the world. It happened there. I mean, we try to blame it on somebody eating a bat at a wet market, the guy that's playing around with it, with the gain of function, with the COVID, literally gets sick on COVID, and
yes, no, the whole
same area that it started. I think it was just so absurd. And I think, he hurt. I mean, if you wonder why people are like vaccine skeptic and unlike normal vaccines, I'm not talking about like, every vaccine. I'm talking about like, some vaccines are, you should take them, trust me on this. You shouldn't think twice about taking them. But people are skeptical because of what Fauci has exposed. And his skeptics knew he was not leveling with us. He denied it, and now we have the proof in many ways. It's sad because this was a guy at the forefront of AIDS research, and he had a long career.
Yeah, I don't know if I would go so far as to say, talk about vaccines, the things that we know already work. Polio, measles.
Well, there are people that are questioning that now. I mean, it's like weird.
But like, some of these things have been eradicated, so they obviously did work. I just think that that's craziness. But I understand for a virus that the thing is that they knew a lot about it, and yet we were told that no one knew anything about it. But it was obvious that they knew a lot about it. They knew exactly what it was, but they were unable to say plainly, either this is an experiment gone wrong, we're at fault, but here's the fix. And I think that's where politicians, and by the way, I think businessmen too, people will accept an apology if you tell them the bad news. And yet he got caught up in this thing where you can't share the facts. You have to share your facts.
The facts weren't, and by the way, the facts weren't
about what facts are.
The facts weren't all catastrophic. The facts were like, keep the vulnerable, keep people with diabetes, with heart, stuff like that, cancer, autoimmune deficiency, keep them. They should lock down. Everybody else should kind of do what they got to do, and get sick and try to get through it. Because my brother had a horrible case, but it lasted 4 days and he was kind of back.
Yeah. So anyway, enough about Fauci. We'll see what happens to him. I don't know.
Someone parroted your call on Paramount recently, and I said, "Are you listening to our podcast?" And this guy goes, well, I do listen to your podcast. I said, well, that's from Bob Sloan. He said, these state AGs that are suing to break up the Warner Brothers Paramount deal are further to the left than the European Union. And you came up with that. I mean, that was your line, and it was so appropriate and so true. And by the way, this deal is breaking up. This deal is so stupid, and these journalists are just, here's why this is like red meat for journalists, because Barry Weiss, who is considered conservative, but she's not really, is going into CBS and if this deal happens, CNN, because WBD owns CNN and she'll be in charge of both, and making it more centrist. Not MAGA, just centrist. And this is just enraging the progressive left that dominates every newsroom and these idiotic state AGs. And there's no rational antitrust violation here. You're telling me combining two studios that are on their last legs. I mean, they produce good movies, but they're not like, people need content, and content is coming everywhere. Lionsgate is producing content. There's so many other studios that are out there, and big tech is producing content. And I'm sitting here thinking, they're worried about putting Warner Brothers and Paramount together like it's some sort of they just lied over the argument that, okay, let's say if they were just separate companies, would they be strong companies?
Well,
would they have pricing power?
You already made the argument. You know the answer to that.
So. No.
Yeah, right.
It's so stupid. It's political. And it's all about Trump, because Trump is friends with Larry Ellison too. There's part of that. I mean, it's just all red meat leftism. And it's the rule of law doesn't matter here. It's a scary time. And I can't believe the press hasn't been more vocal. Like, it should be patently obvious. Now, there are reading the Wall Street Journal editorial page, listen to us. Like, it should be more obvious that this deal should fly through and be approved. And, they're before a very left-wing judge. So, I mean, who knows what's going to happen? I think even this judge will not be able to stop this deal, because I think when you get to court and, you're Bonta and, you're going to try to argue that, like, these sort of, that this is like antitrust violation when you combine two crappy movie studios together that are under, that's, this is like, say, two buggy whip salesmen shouldn't merge, because when the buggy business is going out of business. I mean, or wickedly downsized, right? So anyway, we'll keep an eye on that. We'll the trial probably will start in a couple months, and we'll obviously be covering it. And now let's turn to the stuff that really pays the bills. It's S3's proprietary data that we share here and unpack for you, that Bob is the maestro at, the granddaddy at. Take it away, Bob. What do you got?
Well, let's go over last week's picks. We had Roper Technology. We had a bullish call, which is up 5.5% on earnings, so that was correct.
Great.
We had a bearish call on NASDAQ. It was down 50 basis points. So you can say we were correct, but more or less a wash. But we had directionally correct. It wasn't just a very strong move. So we were 2 for 2 last week. This week, we have a couple of new picks, which is International Paper. As you know, it's North America's largest containerboard and corrugated packaging producer. The price is up 10% year to date to $43. It's up 28% over 3 months. Short interest up just 3% year to date to 53 million shares. Is a bullish setup into Thursday morning's earnings call. So that's our call. So we're bullish on IP, International Paper. We have one more, which is Regeneron Pharmaceuticals. REGN is the symbol. It's the biotech behind the Eylea for eye disease and Capexin. Anyways, it's got a lot of blockbuster, broad allergy applications with Sanofi.
Sounds like something I need.
I use their stuff too. The pollen's been terrible this year. It's a bearish pick. We got the price down 9% year to date to $701. It's near 52 low. Short interest is up 42% year to date, 4 million shares. So we have a bearish setup into Thursday morning earnings. We're signaling downside move. So let's go to the next. Let's go to what's next. One of the things that we said on a June 18th call with you, our show, we said, the hedge funds and active managers were underweight the index on the long side, and so they think it's just too much too fast, and that's exactly what happened. And if you look at what's happened today after the close, obviously the market sold off quite a bit, but maybe not due to CapEx spending, but reaction to oil, and possibly a much more hawkish Fed. But you can see here that year-over-year change in U.S. information technology positioning. You have short interest is up 90%.
Whoa.
Hedge fund long up 44%. Active long, meaning mutual funds, up 31%. So short interest is up, rising faster. Conviction is short, rising faster than the conviction on the long side. And so people have been they're just skeptical. And a lot of this is coming out piecemeal. Some big investors are saying we missed the AI trade. Some people had really big outside returns riding this. On days like today, they're giving some of that back. So the market is still set up this way, coming into a lot of these big earnings today, like Microsoft, et cetera.
Bob?
Yeah.
Can you hear me?
Yeah, I didn't. So next. And as we talked about, this is a kind of interesting slide. So if you're looking at information technology, it's about 4.5% below index weight on the long side, while its short weight tracks the index. So it still has the same trade, right? It's skeptical. It's the widest long short gap in the panel. So, still all the way up on the upper right-hand corner. Healthcare is the mirror image. It's overweight long at 14.6% against 9.3 cap rate. So the most crowded trade is in the healthcare sector. And it's interesting because that's where the most jobs have been created. How much of that is interest rate sensitive, oil sensitive?
You would think the most overweight would be AI.
Correct, but it's not.
Interesting.
So this is something as we expanded our data set to include the long side and then do the same thing. People know us for short interest, but now we're also producing daily short interest numbers and also positioning numbers on a daily basis. You can see how the market is set up. You're not guessing anymore whether or not investor types and cohorts, how they're actually reading the marketplace.
So what does that mean? It could be a sell-off in this.
Well, yeah. So as the last slide was that the shorts were right, they continue to be right, and that's the same thing. You're not seeing a shift in active longs being at index weighting. It's below the index weight, but you're seeing the short basically being at index weight. So what does that tell you? It tells you people are a little bearish. They're not bullish. Whereas healthcare, it's just the opposite. You have longs being over and above the index weight.
Well, can I make it a suggestion that maybe this is a recession play? People, with the 10-year, the 30-year spiking, sure, that people think healthcare is the one place that might be safe if we hit a recession.
Could be, but more likely it's just that is where the jobs are being created in the economy. That's where job opportunities are. That's where people are actually getting hired. And so it's good for those companies in the healthcare sector. And, there's obviously AI in healthcare too, right? Because the unleashed potential of using, better probabilistic models in telecare health, in drug development, et cetera, could save these companies billions and billions and billions.
Sure.
of dollars, right? In terms of development cost and also speeding things up. Yeah, there's all these different things with it. So it's all those things. Probably a less risky way of playing the CapEx spend of AI, but doing it in a way that has the tailwind of the overall economy behind.
Well,
All right, next slide. This is one of my favorites. Look at the short interest trend for SpaceX, and SpaceX knows this satellite company that has Starlink, et cetera, that just launched at $1.5 trillion launch, got about $2 trillion. The stock is down 42% from its June 16 high, and the notional, meaning the amount, not number of shares of short interest, stands at about $24 billion. It's about 32% on the float. And, Q2 earnings hit on August 4th, right? 2 days later, the first lockup frees up about 911 million shares, right? It's more than the entire public float becomes free to sell. So, the shorts understand that they're not waiting for the public float. They've added 37 million shares. So if you count the amount of shares created by the short selling community, it's a lot, but it's not 911, right? So it's the highest build since the listing. It's very new. You're seeing people are making a lot of money on this trade, shorting SpaceX. But much more interesting when you take a look at SpaceX short interest is larger than Tesla in dollar terms. Right. So if you look at the bottom, the black line is SpaceX, blue is Tesla. Now you got to remember, Tesla is in the S&P. It's in every index, right? So for SpaceX, which is not in the S&P, as being staged more or less into NASDAQ, for it to be shorted this much and does not have the ability where you're shorting an index, you're shorting the stock. That's not in that number because it can't.
Interesting.
So it's telling you that people are just massively bearish on SpaceX.
They got their asses handed to them on shorting Tesla, famously. Our buddy Jim Chinos was out there and had it.
But took people out. I mean, look, these things can and will. They are widow makers, as they like to say. It can take you out, but that's not to say that short sellers are not making a lot of money in the interim, because they are.
Right. I mean, I'm sure Jim made some money in the interim before Elon got his act together. And he did, one thing, that's why I think short selling is such an appropriate market play. And it's just good public policy, short selling, because it alerts companies to the problems that they face. Now,
it's funny you should say that, because our experience has been in our business that the investor relations folks at companies, we don't charge a lot of money. I mean, for some of these companies, it's not even like their Uber bill. It's like 1/100th of their Uber bill. And yet they go to the CEO and we say, the short interest in your stock's going through the roof. There's a real knowledge gap between the corporate community and the investment community. The investment community, we do a lot of business with. They get it. The corporate community just does not. They're not turned on to this. They don't look at it and say, well,
they look at short selling as the devil. And
they do. And
taking their company out.
The problem, right? If you're a good manager, you should want to know the negative news about your company.
I know. I was at a conference once with Joe Nacera, the longtime business journalist. Do you know Joe?
Yes.
Yeah, he's a really smart guy. And Joe mentioned, and I laughed at him at the time. This is almost like an apologia from my standpoint. That company should, remember Herbalife was being shorted by Ackman.
Yep.
That Herbalife should have brought Ackman in and said, okay.
100%.
And I was like, come on, really? But
yeah,
kind of right. Now, amid all Ackman's pressure, I mean, I'm sure they got their act together. I know Elon, like when Janos was doing his thing, shorting the stock and going on TV about it, saying here are the accounting problems, here are some of the metrics, the problems with the balance sheet. Clearly, Elon got his act together. Production problems he started to work them out. I mean, so short selling has a real public policy, um, uh, aspect to it and benefit. And demonizing these guys is just. By the way, you know who loves the demonization of short sellers even more than just regular corporate people? Penny stock salesmen.
Yes.
There are far more touts out there. People that are touting crappy stocks and making money from pumping it and then dumping it. Then there are, short sellers, kind of playing fast and loose. Far more. I've seen it throughout my career. And by the way, I'm not someone who sits there and talks to short sellers all day. I get tips from short sellers, and then I'm like, I'm a little bit hesitant because you've got an axe to grind. And I don't get that. That's why I don't get many of them. But I look at this as a public policy standpoint. You need that contrarian voice, and because the markets are so filled with touts.
Well, we can move on, but just last word on this. It's part of how we regulate markets.
Yeah.
The SEC only has like $1 billion budget, maybe two. It's not a lot. I mean, the technology budget of one firm on Wall Street dwarfs the amount that we spend on regulation. You can say that's right or wrong, but the informal role of the market itself, negative bets, and the research behind it takes way longer than on the long side. And because the risk is way much more. Generally, been study after study after study after study, often commissioned by the SEC. You can look this stuff up. It tell you that, like 9 times out of 10, the claims are correct. So if you're management and you don't want to hear something that's negative about your business, what type of manager are you? You're not getting the feedback that you want. Yeah, that's a whole different thing. Next slide. So this is really interesting. FICO, we were talking about interest rates. One of the reasons why you want that CEO's comment about managing the yield curve to be correct is because it is hard right now. Home sales are sluggish, and you want to bring down the long end so that you can make home ownership affordable, given the inflationary pressure that people are feeling, and given the fact that oil is high. And no one's really made the case yet that I'll take $5 oil and we'll help you if we can denuclearize Iran, because that's the trade-off. If you just said it that plainly, I think people would say, yeah, I get it. But
it also won't last for $5 for forever if you
forever, but no one's making that case. Okay, that's fine. But one of the more interesting things is Fair Isaac, which is the FICO score, right? It's a $31 billion analytics company. Everybody knows what the FICO and credit score. It's been the standard for basically how every mortgage is decided. If you're 700, 750, 550, 800, whatever you are, that's a key input for how loans are made. What's interesting is that they lost their GSE mandated exclusivity when Vantage Score 4.0 won federal validation. The stock's down, by the way, after the close about 13%. So you can see here, shorts have more double their position into the re-rating, or to the fact there's going to be more competition. But they've got a little to show for it, right? Because you see, the price has bounced a little bit. However, on the close today, you're going to see that is going to dip quite a bit. So short sellers are going to be rewarded here. Prices up 50%, but it's off 15% or more as we speak right now. So this is something we thought, given the earnings today, we'd show you that there's high conviction here pre the announcement of earnings that there was going to be some issues with the company.
That's interesting.
Yep. And then we can go maybe one more.
Absolutely.
Yeah, we can skip this. We already covered this in the intro.
which was what? The
Bond,
stock.
we've talked about bond ETFs and how there's been little shorting, and people are expecting higher yields. It's basically the story.
Yeah, I mean, I think that's worth getting into just a little bit because a lot of our viewers kind of tap into bond ETFs to play the market. They've been getting crushed along, which obviously so because rates are going up. I do think though, Bob, that this rate play is interesting because it seems to me that if there's one thing that could cause a recession is much higher interest rates, which are very possible. Don't you think?
Yeah, but I mean, we're looking at short interest in these, the IEF, which is the 7 to 10 year Treasury bond, and then there's TLT, which is the 20-year plus, longer end of the curve. The short interest has either been flat, right, or way off.
That's interesting.
So it's just nobody's pressing this bet
All right.
against.
Yet.
Yeah, well, you can see that. I mean, you just look at the TLT. The blue line is the short interest. It's just it fell and now it's been flat for the last since March, basically. The same thing with the IEF. It fell and it's more or less flat. So there's not been a lot of activity or any conviction shorting these bond ETFs.
All right. Let's leave it there because with a question mark.
We're the question mark. We'll see what happens. But we're not a lot of activity. And then lastly, this is something we've been talking about for quite some time. And there's been a front page story in the Wall Street Journal today about single stock ETF with Hynex, which had an IPO and had a disastrous listing. Market sold off like $400 billion. And some of these single stock ETFs in South Korea have really exploded in the face of the holders, and it's problematic because it's been such
isn't that like a contradiction in terms? And
it is. It's honestly, it's like the craziest thing I've ever heard of.
I remember I covered a hedge fund manager back in the day when I was at a mutual fund manager when I was at the Wall Street Journal. I was covering mutual funds who invested in like one stock, and then he wrote it up. He was got great returns, and one day the thing blew up, and he was out of business.
Charlie, I don't quite tell you that I understand the need for a single stock ETF, but they exist. And but
why don't you just buy the stock? Why need that makes
because there's that's a good question. Because the leverage available embedded in the ETF is higher than you can get.
Okay,
elsewhere. So it's a much higher leverage play. And
so there are certain benefits from
if you want a more leverage, if you want more exposure, you buy a single stock.
Okay, I learned something about it now.
But still, to your point, generally those things don't end up so well. So on July 8th, we flagged Hong Kong's crowded short book and Korea's extended long positioning, how the active longs were running way ahead of the shorts. And then in Hong Kong, they had the actual reverse happening. So you had the spread between the Kospi because of the Samsung and Hynex. That was in July 8th. And we said, this is a really interesting trade to look at. Eventually, these things cross. Murmurings of Chinese intervention and stabilization trends versus just an over-levered and very, very, very hot Kospi, and lo and behold, you see these things cross.
All right.
So if you're short Kospi, long Hong Kong, like we said, that was a pretty good trade. And that's what the data told us. We're not recommending people do that, but we see these things, highlight them, up to you to do what you want to do. We don't get paid for investment advice, but the data sometimes is so strong, you have to just call it out.
Uncompromising, objective data is what the market needs. And it's what S3 Partners does on a daily, actually a minute by minute basis. I've been to the headquarters. Those guys are working around the clock over there.
Well,
You're a tough manager, Bob. Let me tell you.
Listen, I mean, this is not a business. If you want to be an entrepreneur, you want to do something on your
Sure.
own. It's a journey for the brave. It's not for the weak. It's not for the weak-hearted. So,
You are absolutely right about that. And you've been doing it for how long now?
24 years. Standing tall in the saddle, and we will keep going.
Because the market keeps asking for you to keep going.
As long as we're needed and people want us.
No, you're needed. You're needed. Well, let's end it there, Bob. Thank you. Another interesting take on the COPSI, right? I mean, I if it wasn't for you, I wouldn't even pay attention to the COPSI, but it's something that everybody should because it's going nuts.
Well, it's foreshadowing today's sell-off.
Yeah.
That's why we highlight it. It's just, sometimes these things, the same trade is happening in different ecosystems and one gets ahead of the other, but they all kind of move the same way in the end.
And you've been not touting, you've been,
We've been arguing this for a while.
You've been arguing this for a long time.
Yes, we have.
All right. Well, we'll be back next week. Same bat time, same bat channel with my partner in crime, Bob Sloan. This is Charlie Gasparino from Fox Business, Fox News, with the great Bob Sloan signing off on another riveting edition of Risk and Return.